In the previous video, we talked about stock indexes, and particularly about the S&P 500 index. Looking at the chart of the index, we can see that basically, over a long period of time, the index is going up. Meaning, on average, the price of all stocks in the index is going up. In fact, over the last 80 years, the average return of the index is about 10% annually. Sure, there were periods where the market went down 20, 30, or even 40%. But generally speaking, the trend is up and to the right. An average 10% annual return for 80 years is a great deal, considering no effort is needed to get that return. And it certainly beats a lot of investors and even hedge funds. But have you ever wondered why? Why has the S&P 500 index had such great returns over so many years? In this video, we are still in the first section of the course, Understanding of the Stock Market, and we'll talk about all the reasons that cause the stock market to go up. Productivity, strength of the U.S. economy, inflation, population growth, self-optimization, and popularity of the index. As always, before we start, if you want to learn more about investing and you are interested in managing and growing your own capital, please visit my website for more advanced courses. You can also join my investing community on Patreon, where I share my portfolio, bring up new investing ideas, summarize earning calls, and discuss various topics related to investing. You can find all the links in the description below and in the pinned comment. Okay, so let's talk about why the S&P 500 tends to go up over the long run. This is one of the most common questions people ask when they're just starting to invest. They hear, invest in the S&P 500 and hold it for decades, but they don't always understand why this works. It's not magic. It's a combination of powerful, long-term forces that drive the index higher over time. First, let's start with productivity. Think about how businesses operate today compared to 50 years ago. They're so much more efficient now, right? Companies are constantly finding ways to do more with less. They innovate with technology, streamline their processes, and improve how they operate. From the assembly line to computers and artificial intelligence, each generation brings breakthroughs that help businesses produce more for less. These gains in productivity lead to higher profits, and higher profits drive stock prices up. Since the S&P 500 is made up of the largest and most successful companies in the U.S., these productivity gains are especially noticeable in this index. Next, there's the strength of the U.S. economy. The S&P 500 represents the heart of American business. These are companies that lead their industries, companies like Apple, Microsoft, and Johnson & Johnson. The U.S. economy has a few unique strengths that make it incredibly resilient. For one, it's diverse. The S&P 500 includes businesses from every major sector: technology, healthcare, finance, energy, and more. If one sector struggles, another often picks up the slack. On top of that, many of these companies operate globally, so even if the U.S. economy slows, they're still generating revenue from markets around the world. And let's not forget the entrepreneurial spirit in the U.S. A culture of innovation and a business-friendly environment help these companies grow and thrive. Now, let's talk about inflation. Inflation often gets a bad reputation because it reduces the purchasing power of money. But here's the thing, businesses can raise their prices to keep up with inflation. When that happens, their revenues and profits grow too. For example, imagine a product that sold for $10 10 years ago now sells for $15. That's more revenue for the company, which ultimately pushes up its stock price. Over time, inflation naturally leads to higher stock prices, and the S&P 500 benefits from this trend. Another important factor is population growth. As the population grows, there are more people buying goods and services, which means more demand for the products that S&P 500 companies make. A growing population also means more workers contributing to the economy, which fuels growth. Even if population growth in the U.S. slows, global population growth provides opportunities for S&P 500 companies, many of which operate internationally. Whether it's Coca-Cola, Apple, or McDonald's, these companies are selling to billions of people worldwide. Now, let's talk about one of the hidden reasons the S&P 500 tends to go up over time. It's designed to include the winners and cut out the losers. The index isn't just a static group of 500 companies. It's a dynamic list that gets updated regularly. When a company starts underperforming, say it loses market share, its profits shrink, or it faces financial trouble, it risks being booted out of the index. And when that happens, a stronger, more promising company takes its place. This constant refreshing of the index ensures it remains focused on the most successful businesses in the U.S. economy. So, in a way, the S&P 500 is always self-optimizing, leaning into sectors and companies with higher growth potential. Over time, this process naturally pushes the index higher because the dead weight gets replaced with companies that are thriving or poised for growth. It's like pruning a garden to make sure only the healthiest plants thrive. Finally, there's the growing popularity of passive investing. Over the past few decades, more and more people have started investing in index funds and ETFs that track the S&P 500. Why? Because passive investing is simple, low-cost, and has consistently delivered solid returns over time. When people invest in these funds, the money flows into the stocks of the S&P 500, increasing demand and pushing prices higher. This isn't a short-term trend. Passive investing continues to grow, and as it does, it reinforces the upward momentum of the index. So, what does all this mean? It means the S&P 500 doesn't rise by chance. It rises because of productivity improvements, the strength of the U.S. economy, inflation, population growth, and the popularity of passive investing. These are long-term forces that work together to push the index higher. Now, of course, there will always be bumps along the way, market crashes, recessions, and periods of uncertainty. But over decades, these forces tend to outweigh the short-term noise, and that's why the S&P 500 is such a reliable way to build wealth. The bottom line, if you stay invested for the long term, you're betting on the growth of businesses, the economy, and innovation. And that's a bet that's paid off time and time again. Thank you for sticking till the end. If you like the content and want to support the channel, please like and subscribe, and see you in the next video.